Today's topic is all values must come from markets, including intangibles such as goodwill and IP. Unless you investigate what markets are doing, you can never value a business. Most sit at a desk, rearrange financials and claim they can value a business. All values and variables, including multipliers, they come from markets. And what markets are doing today, not what occurred 20 years ago, and not what is predicted into the future. Therefore, if there are no markets, there is no value. The coronavirus should have taught you that. Every report you see based on the following: EBITs, EBITDAs, future maintainable earnings, discounted cash flow, weighted average cost of capital, or multiple values, you know you are dealing with someone who has no idea. If markets disappear, so does value. But if you have suffered loss due to such reports, you should sue and seek legal compensation at law. These reports are not based on market activity, full stop, even though they claim so. So let's provide the proof that is needed to throw such reports in the bin or attack them at law. The High Court of Australia has rejected them. You should too. All valuation reports must be based on the law, but these are not. They are based on accounting and taxation concepts which have absolutely nothing to do with markets. They record prices paid which are never reconciled back to market values. Depreciation schedules and balance sheets rarely reflect true values. There are three main High Court decisions that should provide guidance to the valuation of businesses. The House of Lords decision in the matter of Muller in 1901, whereby Lord Macnaghten stated that goodwill value must come from a source, and went further to say that it is the attractive force that brings in custom. If it comes from a source, it can be identified and measured. It is not and never will be the rearrangement of expenses. Sales is the only number that is provable. Sales are proof of interaction by the business with markets. But they must be sales with margins, and they must be transferable. This is what is missing in nearly 99% of reports. If the report is not based on sales, it is rubbish. The Australian High Court decision in Spencer's case in 1907, where it was held what constitutes market value, values must come from markets, not the practice of rearranging expenses based on accounting knowledge. The latest High Court decision in Placidome Inc. here in Australia in 2018 has rejected accounting concepts of goodwill valuation. The High Court has rejected them based on unreliability, and I claim that they are unprovable and misleading at law. They ignore the valuation of tangible assets. Finally, the High Court justices have got it right. To value any business, you must be trained in the ability to value tangible assets as well as intangible assets. And to do so, you must get your information from the marketplace. If you are valuing property or rents, you must investigate the property market to determine values. If you are valuing vehicles, you must study new sales, used sales and auctions to determine values. If you are valuing plant and equipment, you must investigate plant and equipment markets to understand them. And if you are valuing stock or inventory, you must investigate suppliers to determine values. And if you are valuing goodwill, you must investigate sales achieved in the marketplace to value such. You can have the greatest idea or product in the world, but unless you can sell it in the marketplace and create margin, you have no value. All assets or components of a business must be valued at the date of valuation. All tangible assets must be valued at market value, and all intangibles must be valued based on the sales achieved in the marketplace at or around the time of valuation. Here are two illustrations that can assist you through life and are a massive management tool that can guide businesses on a daily, weekly, monthly or yearly basis, review basis. The valuation worksheet. By filling in and comparing from time to time, this is a graphic display, and that will help you to, or allow you to recognise early warning signs before they appear in financials. Clearly, something has gone wrong. In the third month, stock is down by 15%, sales have dived by more than 20%, there must be a reason. This comparison will set off alarm bells and allow early intervention. Unless you can fill in each space with accuracy, you know nothing about business or business valuation. This can be converted to graphs showing KPIs. All of this is based on sales activity in the marketplace. If sales go down, so does intangible asset value. This may be a management issue and not an industry issue. Therefore, plant and equipment and stock values should hold. All values must come from the markets, which means any report based on financials alone is worthless. And there can only be one market value, not a value in the future, but the market value today, and not differing values as found by those who sit at a desk and rearrange financials. Now, the second one is the market value line. All values come from markets based on sales. And there is only one market value, not differing values. All sales occurring in the marketplace will either be above the line, on it, or below it, and are best explained as a buyer paying a premium or obtaining a discount. I have attended lectures whereby most hold the view that there are many values and it depends on who is buying, which will alter the price of value. They claim that if a buyer comes from the same industry, they should pay more for economies of scale or synergistic benefits. What utter stupidity. Market forces dictate values. If a buyer is to get the benefits, why would he pay more to someone who is forced to sell? Doesn't make sense. They try to invent values, but if they're not supported by markets, they are a waste of time. Markets change all the time, and you must change with them. Markets change all the time, but most analysts have been using the same multiplier for the last 30 to 50 years. How can their reports be trusted? This next illustration should reveal that most are out of their depth when preparing business valuation reports because they have no idea on how to value tangible assets or where to locate them. Every business is made up of tangible and intangible assets. Most reports do not include tangible asset valuation. Therefore, they are not complete and cannot be called a valuation. Then, unless you can value businesses, interpret cap rates, read leases, compare rentals, lease terms, tenancy rates and locations, or tenancy sizes and locations, and value tangible assets, I believe it's impossible for an analyst to make an accurate determination on values. Valuers should want the best for their clients, but the old methods they use do not deliver it, and tangible assets do not feature in their reports. Therefore, protagonists that produce reports based on the rearrangement of expenses such as EBITDAs, future maintainable earnings, based on discounted cash flow is without logic or reason. They ignore the source of revenue streams and always seek to create an artificial return that is not based on market numbers. They create an artificial return which is misleading, therefore fraudulent. They know no other way. Any time an analyst uses discounted cash flows or cap rates in a business valuation report, I recommend you attack it. Cap rates should never be used in business valuations. If you cannot value a business on today's numbers, you will never improve your valuation by trying to predict the future. Discounted cash flow is not a predictor of value. At best, it's a budgetary tool. Always attack where they got their future value from. It is complete rubbish in business valuation reports because earnings and expenses are not robust and predictable, such as property returns. You can never prove the income or growth rate, nor the interest or risk rate, and you can never prove the expenses or occurrence dates. The world needs a valuation method that can value any business on any day, week, month or year, and it must be based on provable numbers, not guesswork. If judges want the truth, then they should reject inferior documentation rather than endorsing it. To prevent future problems, judges and solicitors should always ask for two valuations. One for tangible assets at today's value, and two for intangible asset value at today's value. That concludes today's presentation. All of the above can be found at valuationworld.org, and I hope you get your copy of my book soon. Thanks for watching.